Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings. Today we're cracking open Quaint Bancorp's latest filing. And trust me, this one has a few surprises. It's less quaint than one might expect. We will explore some potential troubles in their books. Quaint Bancorp is a Pennsylvania-based holding company for Quaint Bank. They offer the usual banking services like loans and deposits, but also get into mortgages, commercial real estate financing, and even insurance through their subsidiary companies. This means they try to make money from many places. First, let's talk about the lending side of things. The bank originates different types of loans. They offer commercial real estate loans, small business loans, and some residential mortgages. Basically, they are lending money to both businesses and individuals. Interestingly, they decided to stop offering home equity loans last year because of low demand. This means they aren't finding it profitable to offer these loans anymore, so they are focusing their efforts elsewhere. Let's look at the loan portfolio, which is a fancy way of saying all the money the bank has lent out. At the end of last year, their total loans were around $541.6 million. Commercial real estate loans make up the biggest chunk, about 55%. That's a little over half the total, followed by commercial business loans at 21%. The rest is a mix of residential mortgages, multifamily loans, and some construction loans. It seems like their focus is on lending to businesses rather than individuals buying homes. What's interesting is they sold $203 million in loans. That means nearly 2/3 of what they had sold off. Digging deeper, the loan portfolio is shrinking. It decreased by $55 million. This is because of repayments, but mostly because they sold a lot of loans. It's kind of like they are downsizing their lending business. Scroll lesson, preferred loan fees and cost grew. Now let's talk about asset quality, which is a measure of how likely their loans are to be repaid. They have something called an allowance for credit losses, that is money set aside in case people don't pay back their loans. At the end of last year, this allowance was $6 million this year. That means they might be having issues collecting on some of their loans. Non-performing loans, as are starting to creep up, they are loans where the borrower isn't making payments. The non-accrual loans alone ballooned from just $51,000 the prior year to almost $5 to $6 million this year. That means they might be having issues collecting on some of their loans. For credit losses, that is money set aside in case people don't pay back their loans. At the end of last year, this allowance was $6 million this year. That means they might be having issues collecting on some of their loans. Non-performing loans as a percentage of total loans jumped from 0.7% to 1.18%. This is a meaningful change. Delinquent loans are a concern. The loans overdue went up massively from just $452,000 to over $633 to $3 million. The bulk is from business loans. The allowance for credit losses is supposed to cover these bad loans, but it went down by $282,000. It doesn't sound like they feel as confident as they should be in their debtors. Let's check where these losses are coming from. Commercial business loans had a whopping $1.6 million in charge-offs. That's money they don't expect to get back. And the multifamily didn't fare better. Construction loans had $187,000 in charge-offs, indicating trouble in their construction lending activities. The bank didn't set aside more of an allowance for credit losses. As a percentage of total loans receivables, it only moved from 1.11% to 1.20%. Now let's switch gears to where they get their money, which are deposits. They have different types of accounts like certificates of deposit or CDs and checking accounts. A large percent of their deposits are in high-rate CDs, as high as 4.99%. These are expensive deposits since they have to pay high rates to get them. These are a whopping 40% of all their deposits. The bank also uses listing services to get more certificates of deposit. They are paying a lot for this. They also have a high reliance on a small number of depositors. One major interest-bearing checking account deposit customer accounts for 8.6% of their total deposits, and one major money market deposit customer accounts for 29.4% of their deposits. It makes them reliant on these two companies, and they are not even in the same state as them. If they leave, the bank would be in big trouble. The average rate they are paying on all their deposits has gone up, which means it is more expensive to retain those deposits. A lot of their deposits are short-term, meaning they have to constantly renew and keep rates high, making things more expensive. As for borrowings, they're using the Federal Home Loan Bank, or FHLB, to get advances. Their borrowing capacity is at approximately $26.6 million, showing their ability to tap into additional funds if needed. The amount of borrowing they did, though, actually increased this year, showing less self-reliance on their own deposits and requiring additional outside funding. It's something to keep an eye on. The bank is also subject to a lot of rules and regulations. One important one is the qualified thrift lender test, where they have to keep a certain percentage of their assets in mortgages. The company is making good progress to keep that relationship in check. Another regulation they have to be careful with is commercial real estate lending. Regulators don't want banks to have too much of their portfolio in commercial real estate loans, and the company's number are high enough that the regulators are going to watch this very closely. It could mean they will have to hold higher levels of capital. Cybersecurity is also a big deal these days, and banks are prime targets for attacks. The company has to follow privacy laws and make sure customer data is protected. They're also required to report any significant cybersecurity incidents quickly. So it's important that they keep their systems secure and have plans in place to respond to any attacks. What all this means is that Quaint Oak Bancorp is facing some challenges. Their loan portfolio is shrinking. They are losing key people. They have a lot of bad loans. They are reliant on expensive deposits, and their portfolio is concentrated in commercial real estate loans. Now, looking at these results, Quaint Oak Bancorp appears to be in a difficult position. They're in an industry that is tough, and the economic conditions aren't helping either. Their commercial real estate loans expose them to risk, and their reliance on a small number of international depositors and listing services might hurt them. It seems as if the bank's aggressive loan growth in the past few years may have been too fast, and it is starting to show in the financials. They will need to be extra careful in the coming months. Thanks for watching. If you enjoyed, please subscribe, like and comment. Thanks for watching. If you enjoyed, please subscribe, like and comment.